All right. Good afternoon and welcome, everyone. I am Jenny Eaton, the program coordinator with the Northland Small Business Development Center. Thank you for joining us today for the Minnesota Paid Leave webinar to learn more about paid leave here in April 2026. I'm just going to start with a few housekeeping notes. Again, the webinar is being recorded, and I'll send a link to the recording and slides to all the attendees afterwards. If you have any questions during the presentation, please use the Q&A feature here in Zoom, and we'll do our best to answer as many as possible at the end of the presentation. So before we dive in, I'd just like to share a bit about Northland SBDC's services and how you can access them, and then I'll turn things over to Ravina, our lead presenter today. So Northland SBDC provides no-cost and confidential technical assistance to small businesses and entrepreneurs throughout the 7 Northeast counties of Minnesota. So we can help people in a variety of ways, from understanding finances, like cash flow and projections, describing your customers, creating a business plan, and walking through the process of financing a business. We also have subject matter expert consultants available to work with clients one-on-one, again, to providing no-cost assistance, but in specific areas such as marketing, human resources, IT, and QuickBooks or bookkeeping. So if you're a current small business owner or an entrepreneur looking to start a business, you can access our services by visiting our website, northlandsbdc.org, and clicking the red Request for Services button. And we will connect you with one of our consultants that's in your area that'll work with you one-on-one. So that's a brief overview of the Northland SBDC services. Today, Ravina Claxton, our Northland SBDC subject matter expert in human resources, is joining us to give us more information around paid leave. Ravina, would you please introduce yourself and kick off our webinar?
Okay, glad to do so. Thank you, everyone, for joining us this afternoon. And just a little bit about, if I can get the slides to move here. A little bit about me and my background. I am the principal consultant with North Shore HR Consulting. My office is located just outside of Grand Marais on the North Shore. I've been working with small business development centers here in the Northland, as well as in the Mankato area for the last 6 years. My clients, both in my North Shore HR consulting business, as well as the SBDC, come from a variety, from many sectors, including tourism, retail, municipal government, many different sectors. Probably of most interest to you as we talk about Minnesota paid leave is that my husband and I own 17 years, a Twin City small 3-employee Twin City retail business. So I'm very familiar with some of the benefits and some of the challenges of implementing new state laws. And my previous work has been in corporate HR, where I managed a variety of leave programs, leave departments. So over the course of decades, I'm very familiar with the challenges and opportunities of managing employee leaves. So today I want to stress items of particular interest to small business owners and those getting started in small business, and share some personal experiences, share some experiences that I've seen some of my clients have, so that you feel very comfortable as you get into implementation of this new program. We're going to cover 4 areas. The first thing we're going to talk about is just general items about Minnesota paid leave. We're going to talk about setting up your accounts, which many of you probably have already done that by now. We're going to talk about how you prepare your workplace, notifications, policy decisions, because the state of Minnesota in this program left some things, knowing that all businesses work a little bit differently depending on your size and sector and many, many things. There were some decisions left to you to make about how you want to implement the program in your environment. So those are the things. And then, of course, we'll just talk about just the ongoing administration of the leave from year to year. So let's just start by talking about when it was enacted and for what reason. It was enacted in 2023 and it launched, of course, in January. So there was a lot of preparation that went into the program. I actually worked with a client that had the same program in the state of Massachusetts, that was also set up by the same folks that set up Minnesota's program a few years back. So it was a familiar program to me. And the law is designed to give our employees a safety net and to provide job protections and payments from the state to individuals who need time off in the event of a serious life event. Serious illness of a family member, birth of a child. Those are the things that have been covered since the 1990s by federal law if you have 50 employees or more, but federal law is not paid. So that's the difference between federal family medical leave and Minnesota paid leave. Now, Minnesota paid leave is funded by premiums, just like any kind of insurance that you purchase. It's funded by premiums made up of contributions. The state envisioned it as a shared cost, and so you are allowed to share those premiums with your employees, and that comes out of obviously their paycheck. But paid leave is whether or not a person qualifies, whether they receive the benefits, how much they receive, for how long. That is all something that is determined by the state, just like an insurance company would determine benefit payments in other types of insurance. So it's very different than earned sick and safe time, which is for the here and there. I can't come to work today because I got a really bad cold. Those are things under earned sick and safe time that 48 hours you are required to provide. That's on your dime. This is a shared premium and benefit paid by the state. So here are the things that are covered under Minnesota paid leave, medical leave. And again, these are defined as events that last 7 calendar days or more. So again, they're very different than earned sick and safe time. So it can be medical leave to care for an individual's own serious health condition, surgery, cancer treatments, anything that's a serious health condition. Family leave, on the other hand, covers 4 different areas. It covers bonding leave for for parenting of a new baby or an adoption, military leave because you have a family member that's on active duty, or an employee has a family member on active duty to care for a family member with a serious health condition, or for safety reasons because of domestic abuse, sexual assault, etc. And so it's important to recognize that these are all the different types of leaves, and they all require the employee to work through the process. For example, if you qualify for medical leave to have a baby and bonding leave, those are 2 separate kinds of leaves and they don't roll into one another. And so a woman that has a baby also has to apply for bonding leave if she wants that at the end of the medical leave period. And again, just to note, these are conditions that have to be, or needs that have to be qualified by a provider. So when an employee goes in to apply, and all the heavy lifting is really on their shoulders, when they go in to apply, there are different certification forms for each of these that they take to their provider and then in turn turn it into the state for review. Here are the employees that are covered Again, different than earned sick and safe time. It covers most full and part-time workers, most seasonal employees, covers if you are an owner or an officer of the company that you are paying yourself a salary or something through the weekly payroll. Then you are automatically covered because there's a wage report that's gone into unemployment when you pay those unemployment taxes. That will also pertain to your paid leave premiums. Employees of religious organizations are covered. Church offices, those are employers and employees that were not covered by earned sick and safe time, but are covered under Minnesota paid leave. Elected and appointed officials were also not covered, but are covered by Minnesota paid leave. There, I will mention a little bit later that you can opt in, and there is a specific process for opting in if you're not paid through normal payroll, independent contractors, self-employed individuals, tribal nations. You have a single member or sole proprietor LLC, just getting started in the business. We'll talk a little bit about how you opt in and under what conditions you may be qualified to opt in. And then you can see who is not specifically not covered. Occasionally, we get questions about whether or not someone is covered because they work over in Wisconsin, but you're a Minnesota employer. Here are some of the questions we hear. My business is located in Minnesota, but some of my employees live in Wisconsin. My business is located in Wisconsin, but some of my employees work remotely in Minnesota. I live in Minnesota, but I work in multiple states for my employer. And here's the definition. You're covered under Minnesota paid leave if you work 50% or more of the prior year, last 4 quarters in Minnesota, or if you did not work 50% or more of the year in any one state, if you live in Minnesota, then you're covered. Excuse me. Now, a little bit about paid leave payments. It's important to understand they're indexed. So a higher paid employee is going to get less of their wages covered. A lower wage worker will get a higher amount of their normal wages covered. The overall cap is 90% of your usual wages up to the maximum. And again, this is just 2025 numbers. And you have to have met, in order to qualify, if you have a qualifying event certified by your provider, then you also have to have earned at least 5.3% of the statewide average over the last 4 quarters to be eligible for payment or benefit payments. Now, that's important because you may have a new employee that comes to work for you middle of the year, toward the end of the year, and go out on some sort of leave with a qualifying event. They also will qualify even though they haven't made this amount because they just got started with you, but they made that with a previous employer over the last 4 quarters. So that's a part of how one qualifies. And also important to note, if you are receiving payments from unemployment, work comp, Social Security, it works just like unemployment benefits. If you're getting other payments, you're going to have to submit that information. You have to verify it as an employer, and your employee will have to submit that information. And then for those weeks that they are receiving those sorts of payments, they won't have coverage from paid leave. So it's not like folks can double up on things. Now, paid leave job protection is also something important to understand. Job protection means that if they take qualified leave, the state says they're qualified, they've met the salary threshold, you have to provide them job protection. You have to return them to the same position or an equivalent position, and you can see how that's defined once they are released to come back to work. Now, they have to have worked for you for 90 days, however, to have that paid leave job protection. And while none of us want to face this because, frankly, we're small employers, we have one employee, we have two employees, they go out, they're going to be out for weeks and weeks. What am I going to do? Well, we're going to talk about some grant money that may be available to you for coverage from a temporary employee or something of that nature. But the reality is, if, for example, I come to work for you and next week I break my leg on the ski hill and I can't come to work for weeks. You're a retail employer, standing job, can't come to work for weeks. They are not job protected. You can release them. You can release them knowing that if they've worked somewhere else and met that salary threshold, that they will have coverage. And I've had to do this. That's why I mention it. It's important. It's an important illustration to understand job protection and qualification for leave. So you may have to say to them, please reapply when you are released to come back to work. But if they have worked for you 90 days, they are job protected and you must allow them back to the same or equivalent job. Okay, that's about qualifying and who's covered. Step 2, set up your accounts. Hopefully you've done this by now. If you're in business, maybe you're just starting out, or maybe you're thinking about starting a business. You're going to have 2 accounts. You can see the difference. The site on the left is the Minnesota unemployment site, where you're going to go in. You may already have your unemployment account. That's where you'll have an account to also pay your premiums beginning at the end of April, where when you pay your unemployment premiums, you're going to be paying your paid leave premiums too. So you'll have an associated account out on your Minnesota unemployment site. You can see at the top where that's what the site looks like, because it's the unemployment insurance account. You're also going to need to set up, and this is important too, to understand that if you don't have an unemployment account, you're going to have to, because you're a religious organization, perhaps your daycare center that's affiliated with a church, and you don't have unemployment coverage for your employees, you're going to have to go out and set up a special account on the unemployment side so that you won't be paying your unemployment premium because you're exempt, but you'll pay your premiums for your paid leave. On the right is the second account you'll need. That is your Minnesota paid leave account. It is called your paid leave administrator account. And that's where you're going to get tagged with an email saying, go into your employer account. That's where you'll see anybody that's applied. You'll have questions to answer about that application from your employee, et cetera. And we'll talk multiple times about that account when we go through the presentation. Now you can see scrolling over here on the right are the kinds of things on that paid leave administrator account that you'll be asked about. Like, did they give you notice? Have they told you that? Because they won't be allowed to apply for leave until they testify that they've told their employer. And so you have to confirm that. You have to confirm that the info submitted about their wage level is correct. You'll have to report any other things that they have gotten, payments they've gotten. Perhaps they had a serious injury and they drew from some of their vacation to their accrued benefit to cover that while they are applying for leave from the state, because it takes a while. You'll have to report that. And you'll also see, though, you can see here on the right, it kind of jumped by, but you'll see where people have applied and the status. So that's always available out there to you to be able to tell what the status is. You'll see if they've been approved or not, and how much they've been approved, what their benefit amount will be, which will be important, and benefit information for tax purposes. Talk a bit about that. So once you set up those accounts, you need to make sure that you prepare your workplace. And first of all, you're going to decide how you're going to cover Minnesota paid leave. Are you going to go to the state? Or are you going to get a private insurance plan? How much are you going to charge? How much of this are you going to share with your employee in terms of payroll deduction and premium? And then you're going to want to update your policies, which we'll talk about. So, deciding how to split the premiums. This is what you're allowed to do. When the paid leave starts, the premium rate, and there's calculators out on the paid leave site where employees can calculate how much their premiums would be, how much their benefits would be. Same for employers. The premium rate for this year has been set at 0.88. That's 88 cents on every $100 of payroll. That covers both the family and the medical leave, which are two separate things, two different things, as we noted earlier. Premium rates applied on wages up to the Social Security cap. And as I said, when you go to pay your unemployment, you're going to be paying on April 30th, the due date for your first quarter premiums that you're paying and that you've deducted from your employee's paycheck. Now, you are allowed to deduct up to 50% of premiums from employees' paychecks, and that's for a large employer, because small employers are a little bit different. You may choose to pay your required proportion, or you could cover the whole thing. So let me talk a little bit more about that. Your reduced premium has been set for 2026 at 0.66 instead of 0.88. Now, you can charge up to 0.44, which means you're actually only paying about 20%, and the employee is paying 80%. But you're allowed to do that if you're a small employer. Who is a small employer? Small employee is small employer is 30 employees or less or fewer. Now, here's a little bit of a kicker for employers that are kind of on that borderline, and maybe they exceed 30, during the busy season and are more in the 20s during the light season. If you have at any point during the last 4 calendar quarters had over 30 employees, then you're going to have to pay the large group rate. So you have to have 30 again, and an average of 100 and average wage of 150% or less is statewide average. So those are the two factors to qualify for small employer designation. Now, how do you make that decision? I have employers. I have one employer that has been in business for decades, but they have such a small workforce of 20-ish employees, they can't really afford healthcare insurance and so forth. And so they are my one employer that actually said, we just want to pay the whole thing. And we'll talk a little bit about some tax implications for paying the whole thing, but that could be a decision you make. You could decide, hey, I'm going to pay 50-50. The state set it up to be 50-50 split. So that means I'm going to pay 0.33 and rate, and my employee is going to pay 0.33. Or I'm just getting started. And I have folks like this. I'm just getting started in business, or I'm kind of struggling right now in this economy. Those folks are charging the employee that 0.44, which is the maximum they can charge, but then they're paying 0.22 as an employer. So it's a nice decision that you get to make for whatever works for you in your business. And you can change that. One thing we know is that this will be actuarially valued, this program, at the middle of the year, and the rate set by the state for the state insurance plan for next year, which may be the same, they may be different. Just bear in mind, if you ever change the rate, you have to stick to the rules as defined here, and you have to inform the employee, which we will talk about the disclosure notices here in just a few minutes. Now, there are small employer assistance grants. My understanding is starting out, I think there's about 5 million annually is a number I read, to support small businesses during an employee's absence. For example, the illustration, let's say they're job protected, but so you have to hire them back in 90 days and hold their job, but you got to hire some temps to cover, or you're going to have to give some more hours to one of your other employees because they're part-time, but you need them to go full-time and it's going to cost you more, or you got to hire some temps. So there's dollars set aside for small employers. If you're that 30 employees or less, you have to qualify. There's a limit on the benefits. You can see on the right-hand side of the page how much that is. The costs have to already be incurred. Okay. And you're going to have to turn in receipts. You'll find out what's available to you when you go to your paid leave administrator account. You'll see that if you're a small employer, you'll see if that grant money is available. Uniforms for new employees, temporary workers, as I said, but you have to turn in receipts. You have 90 days of when the employee's leave ends to turn those receipts in, but you still may be able to get funding to help offset the costliness of, coverage for these employees. Now, the other thing you have to decide about offering this paid leave insurance program is, are you going to go to the state or are you going to go to an equivalent plan? You can actually go in advance of offering a quarter before. This is not a decision that has to be made at the end of the year for the next year. But there are a variety of equivalent plans. These are insurance carriers that have been approved by the state to offer an equivalent plan. Has to operate by the same rules, but the premiums could be different depending on that particular, now they can't exceed the charges that I just said were the rules about paid leave. They can't exceed what you can charge an employee, but the rates could be different. Now, in reality, I only have one or two of my small businesses that have gone to an equivalent plan, even with 40 employees. Frankly, the insurance company doesn't want to underwrite them or has told them that they can't underwrite unless the small employer has multiple lines of insurance. You have health insurance for your employee, you have disability, or you have the long-term disability insurance, life insurance, things like that make it more attractive for them to offer to underwrite your paid leave program. So they, at this writing, there were 20 private insurance plans. Now you have to apply. You have to pay a fee. I believe that fee is something like $250 every year, but you can offer an equivalent plan through an insurance carrier. You actually can bond and offer, self-insured coverage, but that obviously takes it, they calculate how much it could cost you. You have to bond the money, all that sort of thing. I don't have anyone I'm aware of that's doing that. But be aware that there's equivalent plan options. Now, here's where we get into the good stuff on the policies. So here are things that you are going to want to decide. I'm going to go through them each. What kind of notice are you going to require? You can require for foreseeable leaves, you can require up to 30 days notice. They can actually apply 60 days in advance if they know they're going to have surgery or baby or something of that nature. But that's foreseeable. But you can require up to 30 days notice. You're going to want to specify how you expect them to report if it's an unforeseeable. You're going to want to have, just like you have for all of your employees under any circumstances, if you can't come to work, who are you expected to notify and by when? You get to decide about intermittent leave. I'm going to talk specifically about that here in a minute. You get to decide how you're going to coordinate with other payments, which we'll also get into, and how you're going to coordinate with other leaves. You have to notify your workforce. There are two things that are involved in that. You're going to need this poster posted. There is a fine for not having the right posters up in your workplace. It's on the state's website, so there is no need for you to pay for these notices. Just download them, put them on your bulletin board or where you put your employment posters. Now, when the program rolled out, small businesses and all businesses were informed they had to inform their employees of how much the premium was going to be, how much they were going to be charged by December 1st, if you recall. However, that deadline has obviously passed. Maybe you're getting ready to start a business, or maybe maybe you didn't get it done. They're not into punishment mode right now. They're into trying to help. And so you need to, the idea is that before you deduct anything from an employee's paycheck, you give them 30 days notice. And Minnesota is very particular about any kind of wage deduction. That's why we have Minnesota wage theft notices that you should also be given. If I can explain more if you're an SBDC client about that. But for paid leave, they're supposed to get a specific notice 30 days in advance, within 30 days of hire or 30 days before the premium collection begins. And that notice is found on the employer toolkit. It's a signed notice. The other requirement is that you have them sign that, give that signed copy back to you for the personnel file, so that if asked, you can provide evidence that they were informed of what the premium would be and when it would come out of their paycheck. Now, I will say this: when you go in to look at the notice, recognize that I always tell my clients, just use the state notice. When you go in to look at it, there are 7 pages, or no, there's actually more than 7. The small business notice starts on it's a Word document, starts on page 7. The beginning, it says large employer notice. On page 7, it starts with the small employer notice. That's the notice you should be using. And it's actually 3 pages long. The first page tells them about how the benefit works, how they qualify, how they apply, all that. Second page tells them in a table form. And if you need any help, just, if you're a registrant with the SBDC, I'll help you with the notice. It's kind of confusing because it breaks it out by family leave and by medical leave. And so that's where you inform them how much of the premium, how much of the, if you're a small employer, 0.66 is going to be paid by you, how much by the employer out of every paycheck. In percentage form, it's not even the exact amount, it's percentage, which makes it a little bit more confusing, but such as it is. Third page is that page where you're going to need to write in your business name as well as your employer ID number so that they can go in and apply if they, under your EIN, so they apply through the appropriate employer. And then that's where the signature line is. So again, 3-page notice, be sure you use the small business one, be sure they sign it. Again, attendance policies, make sure that employees understand that you're required to comply with the normal call-in procedures. Just because, you've applied with the state doesn't mean you don't need to go through our normal procedures. And the 30-day notice is what you can require, but obviously if they break their leg on the scale, they're not going to know 30 days in advance. And so it's as soon as absolutely possible. One thing you need to understand is that the maximum that, they can have 2 qualifying events in the space of a year. They can only have the maximum for any qualifying event if certified as such that they need all that time by their provider. Maximum is 12 weeks. But if they have a 12-week event and a second qualifying event that's different, the maximum is 8 weeks. So that's a total of 20 weeks. Under Minnesota paid leave law, they can take it either continuously, so break their leg, they're out till they recover, or they can take it intermittently if they have qualified. And intermittent leave could be things like, a common one I saw was things like migraine, or where you wake up in the morning, you're just debilitated until, you're able to take your medicine, get some rest, etc. Maybe you can come in the afternoon to work. That's a common one. It could be some sort of chemotherapy treatment, dialysis. It could be, and again, serious asthma attack. It could be something like that. Once again, it has to be qualified. But as an employer, you can decide 2 things about intermittent leave. You can decide in what increments of a time you will allow it to be taken, and how much of that total possible 20 weeks you will allow to be taken. So you can set that minimum increment of time. So you can say, all right, you can take paid leave in 15-minute intervals. Now, keep in mind, the heavy lifting is on the employee side because they're going to have to be reporting to the state. If they qualify for intermittent leave to be paid by the state, they're going to have to be reporting all of this and keep good records and turn it in on time to get payment, etc. That heavy lifting is not on you. It is for coverage, obviously, but you'll have to verify it in your paid leave account or in your administrator portal. But a lot of the heavy lifting is on them. Now, you can say, I'll allow it to be used, and this is something you say in your policies, allow it to be used in 15-minute increments, or the maximum is 1 day. I will only allow intermittent leave to be used, paid leave on an intermittent basis. You have to take a day. What's the difference? It depends on your business. I have a small manufacturing company that said to me, I couldn't possibly run my production shifts if I was having people come in midday or an hour here and an hour there. I couldn't possibly run production. So they have to take it in a 1 day increment. I have small professional services clients, doctors, chiropractors, dentists that say, I'm so grateful to have help in this economy and with this, labor shortage that I have in this particular sector, that if you can come in for an hour or two or a half a day, some of my employers said it at half a day, I am grateful for that. So just make it clear before you ever start out and before you have one, before you have an application. Now, the other thing you can decide, will you allow the entire 20 weeks to be used intermittently? State law says you have to allow at least 480 hours or 12 weeks to be used intermittently, but you don't have to allow the whole 20. Once again, something for your policy. Coordination with other payments. If you provide PTO, vacation, earn sick and save time, which you have to provide, you have to allow them to use that if they've accrued it. Okay, once it's theirs, you have to allow them to use it. Now, for the ski hill example, if I need my check, I want to use what I've got available vacation, they got to report that. You got to report it because they're not going to get paid leave for it. That's a substitution pay. You have to do that if it's an accrued benefit they already have earned, or they've got, hours in their ESST bank. But you don't have to do supplemental benefits. Now, that's top off. Let's say they're fairly high paid employee and they only get 50% of what they regularly earn per hour. And they want to supplement PTO, ESST, maybe you have a short-term disability plan, vacation pay. You don't have to do that because the state recognizes that, this is a lot of accounting. It's probably in your best interest as well as that employee's best interest, but there is a recognition that that requires a little bit. When I write policies for employers, I will say supplemental benefits topping off is available the first payroll period after the state has determined that you qualify and how much that amount is. Why do we do that? We make sure that you don't get in an overpay situation where you've let them top it off with vacation, but then you got notified how much a benefit payment was going to be in, and like I paid them over 100% of what they actually get, so now I got to go back and collect it because the state's very specific in saying you can't make more than you normally do. And so that's something to think about in your policies. Now, just like any other kinds of leaves, when I talked about the job protection and my example where they might qualify for benefits but not job protection, you have to keep in mind there are other Minnesota state laws and federal state laws that run also and cover that person, or they may cover that person also. A good example is parental leave, pregnancy and parental leave, which is a state law. It's unpaid time, but it does job protect a pregnant worker. Let's say that person that just went to work for you came in and announced that they were pregnant. They may not have 90 days of job protection from you under paid leave, but they certainly have it under the Minnesota pregnancy and parental law. So when you write your policies or you're updating your handbook, you want to make sure that you say all leaves run concurrently to the extent allowed by law, so that they're not taking paid leave, then they're taking parental leave, and now they're beyond 12, beyond 20. So leaves run concurrently. Just be aware of that. Now, And I'm going to breeze through this. There we are having, and Jenny, I'm not sure if you've got the date in front of you for if you're a hospitality employer, you're a resort owner, you're a restaurant owner that's only open during a season. You could qualify for seasonal hospitality exemption. This doesn't apply to, I had one employee that was a retail business in a tourist area, but they weren't in one of these lines of business. And so just because they hired seasonal employees didn't mean they were exempt by the seasonal exemption. So most all hospitality workers are covered, but there are under certain conditions, you may qualify for an exemption. But you have to go through a process. And once you do that and they're qualified, that seasonal worker cannot take paid leave, will not qualify under state law, and the premiums are not owed on their wages. You have to be in the hospitality industry. You have to qualify, and they cannot work for you more than 150 days in a 52-week period. To qualify, you have to be one of these types of businesses: restaurants, hotels, motels, lodges, resorts, food stands, we have businesses that do concessions all summer long, mobile, seasonal food businesses. You may qualify. You may qualify there are some resorts that have year-round staff like groundskeepers, but then they hire up for everybody else. You could have some that qualified for that seasonal exemption, but others that didn't. The basic rule is, and again, if you think you may qualify, I urge you to come to our next workshop on this. Jenny, were you able to pull up the date for that?
That will be on Thursday, May 7th at 10 a.m. And I will put the link to register in the chat.
And we'll go through the detail, but essentially in the other part of, you have to be in one of those businesses I just mentioned, but you have to bring in most of your revenue within 6 months, and your receipts from your 6 highest months have to be 3 times greater than your receipts from your 6 lowest months. You have to qualify every quarter. Again, some may qualify, some may not. So you'll want to find out more if you think this could be you. There's another thing that you should be aware of. Small business owners or business owners who are independent contractors, sole proprietors, single member LLC. If this applies to any of you and you are not a W-2 employee, so you might be taking a once a year draw or something. You're not going through your W-2, your payroll, then you may want to opt in. That is a completely different process than I've talked about. The opt-in is a tab on the paid leave site. Here's generally how it works. You know that you find out that you're going to have foot surgery in a few weeks or a couple months. You could apply a quarter in advance of that known surgery date. You're a single owner, a single member LLC. You're going to have to shut down your business for that period of time, maybe something a little more serious than foot surgery, but you're going to have to shut down your business. You can go in and ask to opt in. You have to show that you, over the last, whatever they designate as the period of time, that you have earned enough to meet the salary threshold. You have to pay the premium, and you have to opt in for 2 years, but you have to pay the large employer premium. The 0.88 is the premium you have to pay. You have to pay it for a year in advance, but still, it may be something to protect your income. And it is worth checking out if you're one of these folks listed. Last thing, and we'll have about 8 minutes left for questions. Um, there's more to follow on taxes, but generally speaking, this year the IRS made these benefit payments. And a benefit payment is not the same thing as a premium. A benefit is when your employee qualifies and they get a state benefit payment or from your insurance carrier, a benefit payment. Now, that reporting is exempt this year. And you would have some, mostly it'll come as a 1099 to the employee, but there will still be some things that you'll be responsible for. However, this year, starting this year, at the end of the year, you are going to have to report the premiums. You can see where you'll report that portion of how much you're paying and how much the employee is paying. And note that if you pay anything higher, they call it the pickup contribution, anything higher than the 0.44, if you decide to pay the whole thing, what the difference is will have to be reported under earned wages, because that's become earned wages for them. It is above and beyond what you have been required to pay. Fraud, I just need to make a couple of statements about fraud. I have already had an employer who had a fraudulent employee apply. Okay. So this is not unheard of, but fraud is knowingly misrepresenting the truth, deliberately hiding important information. They apply for paid leave using somebody else's name. They lied about it, about their situation. They filed inaccurate reports. An employer submitted false records. There is a fraud reporting form front and center out there on the paid leave website. I urge you to report these things. The specific example one of my employers had was that they got notified they had a application. They went into their portal to their administrator account, saw the application, looked back through their records, and I'm like, well, we have never had an employee by that name. Obviously reported it within the portal, and that went away. But you know, we all need to do our part in protecting the integrity of the program, and that's how you can help. So that is the conclusion of today's presentation, and I would entertain or try to answer any questions you might have.
If you would like to ask any questions in the Q&A, we did have one come up about self-employment that you did touch on later, Ravina. Just a daycare provider that is only the only person there, no employees, about how they would go about that process for being self-employed and looking at qualifying for benefits. But I know you did talk about the opt-in process briefly, and there is a significant amount of information on the paid leave website about that process and walking people through the steps to opt in as a self-employed individual. So that, I mean, that right now we are looking at eventually in the future having a self-employed specific training also, but it's definitely a bigger topic there.
Well, and just to note, if you've got some specific questions, and especially around these policies and how I decide how I want intermittent leave to be used, you know, how it plays with other benefits, you know, please get in touch with the SBDC if you're not already registered. And it's a lot easier to help you just one-on-one. We'll get a virtual call set up, get your questions answered. I help employers with a lot of handbooks, trust me. And we'll get this all defined for your business and your needs.
Absolutely. While doing these trainings, we've definitely understood that the needs of every business has been very different. Every situation is unique to the business. So um, reaching out to us for that one-on-one technical assistance could be really beneficial to get those really specific questions answered. We did have another question about getting a step-by-step for setting up an account in the state's portal. I'm not sure if that's on their website currently.
It's a pretty easy walkthrough once you get started. I think the portal is a two-factor, so you have to set up that portion. But from what I've seen on the websites, they pretty much walk you through each step. If you get hung up, we can certainly help you, but I've worked with a lot of employers and it seems to be pretty intuitive.
Then there was a question about page 7 on the small employer notice. I think for reference, they're wondering where to find that page 7. So I know that on the paid leave website, there is that employer resource toolkit that has that sample standard notice. And in there, there is that page. So I will go ahead and put that in the chat.
Great. And the reference to page 7 is just to say it's a pretty big Word document and you don't have to provide all of that. The first one is for a large employer who's got a different rate than your 0.66 if you're a small employer. So I'm just saying in the Word document, go to page 7 that says small employer notice. And then you've got page 8, 9, and 10, which are the ones you need to fill out, give to your employee.
A question earlier also just kind of reiterating with underlying conditions or maybe chronic health conditions that are more than 7 days. They just wanted to verify, that intermittent leave could happen when there's flare-ups of certain conditions, correct?
Correct. There is, I think at least, as I recall, there's one other caveat to an intermittent leave qualification. It has to have 30 days have to have passed and they have to have had at least 8 hours, I believe it is, of that issue in order to qualify with the state. And then you're setting the rest of the parameters about how long and how much time they have. So it has to be, it has to meet all of those things plus a couple of other things relative to intermittent. But those are some of the ones that I have run into most frequently are things like migraines, asthma, things of that nature.
Okay. Well, thank you everybody for joining us today, and thank you, Ravina, for all the information you provided. Just a reminder that there'll be a link that pops up for a follow-up survey when you close out of this webinar. We appreciate your input on there. If you'd like, you can take a look at our website training calendar for future trainings, or you can go to our website to register for that one-on-one technical assistance at the northlandsbdc.org website. Thank you, everyone.
Thank you.